Okay, perfect. So you can see now, right?
Yes.
Now, what is Forex trading? Trading is this means of exchanging something for something else. And in the case of Forex trading, you're either buying or selling one currency for the other for profit in a layman's language. Forex is like going, okay, you would not understand, but if in Nigerian terms, we call them aboki, people that we look for when you're going to a particular country is either at the airport or you go to a particular place where they do an exchange. They're called bureau de change because you go there and they give you the currency that you want in exchange of the currency that you have. That is what foreign exchange is. But it's just that we're not doing it in the digital space. But it is actually happening. As I'm talking to you now, somebody is actually in a particular place or at the airport exchanging their own currency for another currency where they are going to. If, for instance, somebody is coming from Nigeria and they're going to Australia, they are looking for they will go to a booth or they go to the airport or they go to a particular place and they'll say, okay, I want to change naira to dollars because naira cannot be accepted in Australia. So, of course, when we describe forex trading in the digital aspect, it's like speculating that a currency will be probably weak than the other currency that you're speculating with. For instance, if you're speculating with euro, that euro will be stronger than the dollar, which means when you take a trade, you want to buy rather than sell. Because why? Euro dollar will get there. The euro is called the quotes, the base. Dollar is called the quotes. Euro is called the base. Dollar is called the quote. So just like I explained, if the dollar is weak, the I said currency pairs, you cannot just trade one currency. It's the same way when you want to exchange if, for instance, like the scenario I gave, you want to change naira for dollars. I cannot change naira for naira. It doesn't make sense, right? You cannot exchange naira for naira. You have to exchange naira for another currency. So in the forex market, you have to be trading two currencies. That's what they call them currency pair. You have to be trading two currencies. So if, for instance, you're trading euro and dollar, euro the base, dollar the quote. So if dollar is weak, that means that particular currency pair is going to buy. But if the dollar is strong, that currency pair is going to sell. The same thing is also applicable to the other, that's the base, that's the euro. So which means when you take a trade, you want to buy rather than sell. A situation where you speculated that dollar will be stronger than euro, you will want to sell than buy. A situation where you speculated that dollar will be stronger than euro, you will want to sell than buy. But if you know that euro will be stronger than the dollar, you will want to buy rather than sell. But a situation whereby you know that the dollar will be stronger than the euro, you will want to sell. Now, there are different types of pairs, currency pairs. They are the major, they are the current, the crosses, and they are the exotic pairs. The major is paired with USD. The crosses are currency pairs without USD as the base or quotes, while exotic are USD paired with a weak currency. We'll take, for instance, the likes of, let me say, which country will I say that the currency is probably weak? Let me just use, for instance, I really do not know, but let me say CHF, because I know that's one currency that people really rarely, because liquidity is actually not really there. So let me say CHF. Now, when you pair USD and CHF, that is called an exotic pair. I'll say it again. When you pair the USD and CHF, that's the Swiss francs, that is called an exotic pair, because you're pairing the USD with a weaker currency. Now, when you want to know which one is a major currency pair, you have to know that they are being paired with USD. Take the likes of Euro USD, GBP USD. They are called major currencies. Now, for the crosses are when there's no USD pair to it, likes of GBP, JPY, likes of Euro JPY, likes of NZD JPY, likes of AUD. AUD is Australian dollar, likes of AUD JPY. Those are cross pairs. I trade cross pair, a cross pair. Now, the next one is time sessions. When I started trading, there were times where had I had to stay awake to understand Asian session. Now, the reason why I said I had to stay awake is Asia when Asian session is open, it's the time here is midnight. It's around 1, 2 a.m., 2, 3 a.m. Yeah, the Forex market is open 24 hours. The Forex market is open 24 hours from Monday to Friday. Now there are different time zones to trade alongside time frames to trade. And the common time zones that one can take trades, or the most popular time frame every trader partake in the financial market, is either the Asian session, the London session, or the New York session. London session, people will say, okay, London session is more friendly. So London session is the likes of the UK time. And for us for me in Nigeria, London session works well for me because our time basically aligned. It might probably just be that UK is 1 hour ahead, or no, we are 1 hour ahead of London. So Asian session, London session, New York session, but people would always say that London session and New York session works better. Now, because I've experienced all sessions, I wouldn't give a time to anything. I've now come to a phase where I'm not saying to myself that, oh, I trade just, if anybody comes to me and say, what session do you trade? I trade all the sessions because my strategy does not require a time session. What it requires is for you to come to my area of interest. If you come to my area of interest, Asian session, I will enter. If you come to my area of interest, London session, I'll enter. If you come to my area of interest, New York session, I am going to enter. Until you come to my area of interest, that is my own time session. Now, the only good side that I've now realized that favors me with the pair that I'm trading is it works well during London to New York session. So these are the things that on your own end, you will practice and get to refine yourself and get to now know, okay, which one works for you, which one does not work for you. Now, with that being said, Asian session, London session, New York session are the most traded time sessions in the financial market. Now, time frames. Yeah. Time frames, that's where you're going to see that on the trading view. From the trading view platform, you'll find different time frame which a particular candle represents, and they range from monthly to minutes. You can see 1 month, weekly, daily, 4 hour, 1 hour, 2 hour, 30 minutes, 15 minutes, 5 minutes. I think the minimum is 1 minute. I don't know if there's seconds, but I think the minimum is 1 minute. So if, for example, you are on a monthly time frame, every candlestick will be representing a monthly candle. Same analogy applies to a 1 hour candle. Calm down. When we get there, you're going to see all this thing visually. Let's just take the theoretical aspects before we get to the practical aspects. So monthly represents a father, just as let's use the diagram of a home. Monthly represents the head of the house, which is the father. Weekly represents the mother. Daily represents the son. Hourly represents the daughter. Minutes represents the grandchildren. What is lot size? Lot size is a unit measuring a transaction amount, or basically the number of currency units you will buy or sell. And there are 4 sizes to choose from. They are the standard lots. It ranges from 1 to 10. Mini lot ranges from 0.1. Micro lot ranges from 0.01. Nano lot is 0.001. Now, the next one is percentage in pips, in points. Pip. It's called pip. 20 pips, 5 pips, 30 pips. Percentage in points is simply a unit of measurement used to show how much price has moved in the Forex market. Or any financial markets. Percentage in points is simply a unit of measurement used to show how much price has moved in the market. It is the 4th decimal point of a price change while the last number is called pipettes and it's usually ignored. So, types of
Okay.
traders. We have different types of traders. You asked me what type of trader am I, and I said I'm a swing trader. There's the scalper. Scalpers are people that and I think, no, I think scalpers, they take their trades mostly from the lower time frames. That's the likes of the 15 minutes, the 5 minutes, the 1 minute, because they are taking trades in the space of maximum 1 to 2 hours. Some of them even go out 30 minutes, they're out, they enter and they're out. They call them scalpers
And
because,
they can still make money, right? You can
yeah,
still make money.
yes, yes. I know of a scalper that is doing so well and is a scalper. You just have to know which one. The same way we have our different names and our different faces, we will have our own different identity in the financial market.
Hmm.
Swing trader. I did scalping, I did day trading, but I felt comfortable with swing trading because I feel with swing trading, I get to accommodate more as opposed to scalping. Scalping just did not work for me. It was just a lot, and it was just a lot of emotions to give into it. It was not just for me. So I disposed it. So I will say this to you. Be quick to learn and quick to discard the things that are not working for you. Don't dwell so much on your weakness. Don't dwell so much on things that are not helping you in any way, shape, or form. Focus on the things that are taking you closer to being profitable. Because if you're focusing on the things that are not taking you closer, they will be distracting you or they will be keeping you stagnant. So I was very quick to discard the things that I know that do not align with me and focus on the ones that align with me. So swing trading aligns with me. There are also day traders. Day traders, they take trades between the day range, 24 hours range. They can enter a trade in the morning and exit the trade in the evening. Swing trader, they are the people. I feel swing traders can also be day traders because there are some opportunities that I see in the market that allow me take trades and I execute and leave that same day. But majority of the times, because I journal my trades, but majority of the times I hold trades more than 1 day. So swing traders, they hold trades a day, two, three, or sometimes even up to a week. Position trader. A position trader holds trade weeks or months. Some Forex market analysis. We have types of analysis. You've been hearing me say from technical analysis, technical analysis. There's also another one called fundamental analysis. But before we go there, technical analysis is a method of identifying trading opportunities that relies on reading price charts. Technical traders use these charts to determine the future direction of a market, as well as possible entry and exit points for each position, which technical analysis can be found in the trading view. That's the charts. That is where
Yeah.
that's where technical analysis happens. You tend to see, okay, what direction is this market going? Is this market going to buy? Should I take in? Is this market going to sell? Should I enter? While fundamental analysis involves researching what is driving market price action, taking earnings, economic data, and more into account. I was not somebody that read news, but all of a sudden I had to start reading news and paying attention to news outlets
Mm.
because there are some economic data that can also make the particular currency pair that I'm trading to affect it positively or negatively. That is called
Okay.
the fundamental analysis. The fundamental analysis are what's the word? Fundamental analysis tells you what is happening in that currency or what is happening in that company that you want to invest in. Fundamental analysis in the investing world, they call it the financial health of the
Okay.
company. In the currency market, it is that what is the currency you're trading, the country itself, what is happening in the country, what
Hmm.
economic data do you think is going to affect that country's currency that you're trading? You want to pay attention to it. For now, just focus on technical analysis. Don't overwhelm yourself with fundamental analysis. I did not start off with fundamental analysis. I focused on technical analysis. When I understood technical analysis too well, I now migrated to fundamental analysis. So for beginners, just focus on technical analysis mostly Fundamental could be news. Have you heard NFP? There's likes of NFP, non-farm payroll, or
What is that? I heard that. I don't know what is it stands for again. I saw some people say
non
NFP.
non-farm. There are two types of NFP. I'm not talking about the crypto NFP. Non-farm payroll. That's an economic data. At the start of every week on Monday, I look at the economic data, and that can be found on forexfactory.com.
Do you ever get it wrong? Like you know how you're a singer and then you just check your analysis and then you put your trades. Do
Mhm.
you ever get like you lose on your trades or you always in the positive side?
Of course. I like that you asked that question. That's a very interesting question. That's why I call you a queen, because you ask interesting and intelligent and wise question. That's very brilliant of you. So yes, 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 of course. That's why I told you yesterday that just be ready to lose money. When I say be ready to lose money, is in terms of you, when you analyze your market and you think that price would obey your analysis, price would not obey your analysis. You will lose money because you completely will take that trade thinking price will obey your analysis, and that was not the
Mhm.
way it went. Now, yes, I've taken losses. I have taken losses. There have been times that I speculated, price went against me. Now, my early phase, I was able to enter into those trades that were going that were going the wrong direction because I was still learning. But now, if I find myself in the wrong direction, it could be that price was not ready to move, and it has nothing to do with me. It has nothing to do with my strategy. That's why I always emphasize journal your trades. Because when you journal your trades, when you're recapping on when you're writing a review of what happened and what went down, you're able to understand, did you lose this trade because you did not obey your analysis? Or did you lose this trade because price went according to the way you speculated, but it did not go the intended direction? That has nothing to do with you. It has nothing to do with your strategy. I'm I,
Okay.
I'm also going to when I share with you this book called, I think, Trading in the Zone or Disciplined Trader by Mark Douglas, you will also get a grasp of what I'm saying to you. As a trader, even the most profitable seasoned trader, even the hedge funds firms, the investment bankers, all of them, the ones moving the markets, they still experience loss because the Forex market is a game of probability. You've heard that. It's a game of probability. There will be times that it will go your direction, be happy. There will be times that it will not go your direction, learn from it.
Mm.
So yes, there have been times that I would take trades. I said to you, September, I did not. I'm going to show to you my performance over the years, so you see what I'm saying. I said to you, September, I didn't take any trades. Not because I experienced any loss. I didn't experience any loss, but I knew if I was a beginner, I would have experienced a lot of losses because I would have been impatient to want to wait. I would have just said, oh, how will this month pass me by and I will not take any trade? I must take it, I must enter and I'll just force a trade. But
Mhm.
because September was flat for me because it did not align with my analysis. And when I say I am a disciplined trader, this is the reason why I said I'm a disciplined trader, because I am disciplined to obey my trading rules. So now there's something called market structures. That is that thing that you said when you opened the chart, you saw that the market was going. That thing is called uptrend, or the market is bullish. And to identify this type of market structure, the market should be creating series of higher high, higher low. Now, there's also another structure. It's called the bearish or the downtrend. When the market comes down, you say the market is on a downtrend. The market is bearish. The market is selling. And that can be identified through series of lower high, lower low. But there's also another structure called ranging or consolidating markets. This is the situation whereby the market does not have any trend. The market does not have any direction. The market is just going up, coming down, going up, coming down, going up. So we also have types of charts. There are most common types of Forex charts, or not even just Forex charts, financial market charts, both stocks, both crypto, both commodities. They have different types of charts, and they are the line chart, the bar chart, and the candlesticks. Now, we have different types of candlesticks that can make you profitable. Eventually, most traders they use candlestick charts. I use line charts if maybe the candlestick, I'm not able to understand what this candlestick is saying. I end up using the line chart. So made out of these options I just mentioned, the line chart, the bar chart, the candlestick chart, the most one that I use is the candlestick followed by the line chart. Yeah, examples of candlestick charts that can make you profitable. One of them is the engulfing candlestick, being pin bar, doji or indecision, head and shoulder, double top or bottom, morning and evening star pattern. I even shared a TikTok video of it today. I posted a video of it today. Don't know if you've seen it on my TikTok. So another one we're going to discuss is emotional control, aka psychology. According to Warren Buffett, until you manage your emotions, don't expect to manage money. So if you know you're not going to control that emotions of impulsively spending instead of you saving, because there's this phrase that goes like this, that the poor spend, the wise, the poor spend, the rich, they invest. So if you do not have, if you do not control your emotions to know that when you feel like your portfolio is going negative, or when you feel like when you enter a trade and the trade has not taken you out, the trade has not taken you out in profit or stop loss, if you don't control your emotions to wait it out, to be sure that this market, if I'm confident that this market is going my internal direction, I'm going to hold myself. I'm not going to close this trade prematurely. I'm going to wait it out. So if you're not able to manage those emotions, don't expect to manage money. So Warren Buffett's wisdom applies to not just stock, but also to Forex trading. Analysis is one thing, emotional control is another. Beginners often close trades too early out of fear, only to watch the market move in their favor later. When you start out, you experience this. I also experienced it, whereby I expect that the market will go this internet direction. But because of the fact that my area of interest is not valid, the market comes to a valid place, a valid supply or demand zone, takes buyers or sellers, and then goes the direction I already intended. So I remember when I experienced that, I always feel like, oh my God, but this is the reason why. But I said it. I knew this trade was going to go this direction. Oh my God, oh my God. So some of these things are the reason why people do not put their stop loss, because they feel like, okay, yes, even if you pass that area of interest that I've already set, I know you will come back, but it's not advisable. It's really not advisable. You always want to cut your losses short. If you enter a trade and the trade takes you out of profit and now goes the intended direction, make peace with it and just know that there will also be another opportunity. So that's why I always say losses, they are your tuition to being better. You want to learn from your losses and you want to celebrate your wins. So even experienced traders battle emotions. Mastering patience and detachment from money is key to consistent profitability. True trading success comes when you trade with peace and discipline, not fear. I remember I had these challenges. I remember when I had, because along the line you're going to experience one or two. There was a time when I was in the phase of not understanding what the financial market was. Then I was also in the phase whereby I was looking for a profitable strategy. Then I was also in the phase of understanding risk management. I also was also in the phase of understanding psychology, how to control my emotions. There was also a stage whereby when I was not crippled by the losses that I've taken before.
Hmm.
The losses that I've taken before, I was crippled by them. That instead of me taking trades, I will be scared. I'll be like, would this trade not be a loss again? Because when they say, oh, trade money that you can afford to lose, nobody wants to actually lose their money, let's be honest. Even if it's $1, nobody wants to lose. It's going to hurt.
No, it's true.
So with that aspect, I'm just like, that's why I said it crippled me. But one Bible verse, one phrase that brought me out of it was 2 Timothy 1 verse 7. For God has not given me the spirit of fear, but of love, power, love, and of self-control. Or some versions, they will say self-discipline. or some versions they will say sound mind. So I always kept anchoring this Bible verse. I always kept anchoring this Bible verse. And with the help of the Holy Spirit, it made me realize that fear failure is not who you are, it's not your identity. That was when the notion of me seeing my losses as my tuition and seeing them as lessons. So why are you
Yeah.
scared? Why are you being crippled? You're not controlled by fear, you're controlled by fear, by faith. Take the trade. If you experience loss, learn from it and keep it moving. If you experience win, good, great. But sometimes we don't want to lose because we feel like, how are we going to be able to fund our account if the money vanishes? But I've not come to a stage where I know that as my anchor, as my brand scriptural anchor is God has given me the power to create wealth. He has given me the skill to get to create wealth. So I've come to trust him. Proverbs 3, 5 to 6 says, trust in the Lord and lean not on your own understanding. So I've tried to not want to lean on the aspect of, oh, when I lose money, how will I be able to fund the capital? I would trust God for provision. Because if the fear of me losing money just because I don't know how I'm going to be able to fund the capital when I lose that money is what is holding me from not taking trades, that means something is wrong. So, like I said, with the help of the Holy Spirit and with the right mindset, I've been able to understand and make peace with the fact that take the trade. What I now did was when that fear comes, I check to be sure the trade that I'm about to enter aligns with my trading rules. That's why if there's a need for you to have your trading rules, I cannot give you your rules. I cannot give you your plans. I cannot give you my plans. It might probably not work for you. You have to create your own plan yourself with the lessons that you've learned. So I had to now say to myself, when that fear comes, I now look at the chart and I ask myself, that's why you see why I say you always want to keep your emotions in check. Just like Warren Buffett says that if you don't know how to manage your emotions, don't expect to manage money because if you cannot control yourself when fear comes, fear is an emotion, is a feeling. So when it comes, you're not crippled by it because like I said, I was crippled in the sense that what that cripple is not like I broke my legs, but I was crippled that I could not take the trade. Before you know, the trade will go exactly how I speculated. And I'll not be saying to myself that, wow, I would have taken this trade. Then when the trade does not go the way I speculated, I'll say, you see, thank God I did not take the trade. Yo, do I want to keep living like that? No. So when I now check that, okay, fear, I just recite that Bible. For God has not given me the spirit of fear, power, but He has given me the spirit of power, love, and self-control. I just feel this sense of release. I just feel like the peace of God comes because the Bible says that His peace will come in the midst of that chaos. It will come. It does not. His peace is not going to take away the chaos. But when His peace comes, even in the midst of that chaos, is going to give you a sense of calm that you will not even be feeling what is happening around you. So when I say that verse, I just have this peace to know that, okay, yes, take the trade. If you lose, no problem. Learn from it, keep it moving. That is, that's why I said, that's why I will always agree that 80% is psychology, 20% is technical analysis. I'm also going to share with you that book as well from Mark Douglas, The Disciplined Trader. So you also get broader knowledge of what I'm teaching here. And last but not the least is risk management. This is the master of everything. Like this is when they say the tip of the iceberg is this um particular word called risk management. So what is risk management? Risk management means identifying, assessing, and controlling potential losses before they happen. It's not about avoiding risk altogether because every financial decision carries some level of risk. Instead, it's about minimizing damage and maximizing survival when things don't go as planned. Think of it as insurance for your money. In trading and investing, risk management is the art of discipline of the risk management is the art and discipline of protecting your trading capital while pursuing profits. A trader without risk management is like a driver without brakes. No matter how fast or skilled they are, a crash is only a matter of time. Risk management in the trading aspect is you identifying that I have made peace with the fact that when I take this trade, okay, let me just even put it out there. There's nothing that comes without risk. Everything comes with risk, especially in the financial market. There's no risk-free investment. There's no risk-free trading tool. Everything comes with risk. Now, what you want to now do is you want to now minimize that risk, not avoid it completely, but minimize it. So if you practice risk management and understand that risk is inevitable, you will lose money, but you want to lose lower than you earn. That means you want to gain more than you lose. Risk management involves position sizing, how much of your capital to risk on one trade. In the trading world, it means the position sizing. It could be the lot size. It could be the lot size. It could be your stop loss. It could be your take profits. It could be those minor things that will be able to measure your capital. Because if, take for instance, you deposited 100,000, or let me say you deposited $100 or $1,000 in your brokerage account, then you're now trading and you're now risking 50,000. Oh, sorry, you're risking 500. That's half of the money, right? You're not risking half of that money on one trade. What do you think will happen? You will blow that account. You upload our account. So I'm really grateful that I never started with this hunger of get rich quick scheme with trading, because people just misconstrue they just have this mindset that trading is get rich quick scheme. Trading is not a get rich quick scheme. It's not gambling. It takes processes. But because of the fact that you're not ready to put in those principles, you now call it a scam when you get burnt. Because tell me why you should deposit $1,000 and you're risking $500. That's half of the money for one trade when you're just still starting when you're just still starting off as a trader. I can never fathom why people would get prop firm accounts when they are just in their building of formative years. Learn the skill. Be practicing. I know that yes, they will say, oh, demo trading is the way you trade in demo trading is not the way you're going to trade in as much as there's an atom of truth to that. But I don't 100% believe it. You have to start somewhere. As a nurse, did you just start practicing some certain things on a human being?
No,
Did you not start to at least lab rat or a dummy?
sure. Mhm.
But does that mean that because of you not practiced on a dummy or you practice on a rat, you'll not be able to do it in a life person, on a human being? It's not possible. In as much as yes, experience is the best teacher. When you keep experiencing, when you keep refining, you know, okay, this one works better, this one does not work better. But you want to start somewhere. So practice on your demo. Learn all these things that I'm saying. Understand how to control your emotion. Learn risk management. Have a skill set. Make sure you've practiced that skill set. Make sure you have a trading plan that you're following. And be disciplined. Because also in the trading world, stop loss, just like I said, placements where you will exit a trade if it goes wrong. That means stop loss is your buffer that when a trade does not go the direction you intend and it comes down, that when it comes to that particular number you've set as your stop loss, it should take you out of that trade and you're okay with the money being lost. If you say, I'm risking $50, I want to get double of that money. So if I enter that trade and I'm risking $50, I want to get back in return $100 or more. It should never be lesser, because that ensures your potential profit is worth more than your potential loss when you do that. But if you do one-to-one ratio, whereby you're risking $50 to gain $50, it doesn't make sense. It doesn't make sense. That means I would just say that you're probably scalping or you're still trying to understand what the market is, or you're doing fear of missing out. You feel like you really, really need to take that trade. But if you know what you're doing, you shouldn't be risking 1 to 1. You should be doing 1 to 2. My minimum is 2, but I always try to want to look for more than 2. I always try to want to look for 3. Moving on, don't expect as you're still in your beginner phase, you will not be risking your capital as somebody that is in a seasoned phase. They will say in business that don't be comparing yourself that you're in your first in your first year. You're comparing yourself with somebody that is in the business when the person is already in their 10 years. It's the same thing with trading. I know that whole ideology of, oh, don't, if you're trading with 0.01 lot size, you're wasting your time. Don't, I think people get misled by that. You shouldn't be saying that, but I know where they're coming from. That there's a stage you will get to, you have to stop using 0.01 lots. But before you get to that stage, keep using your 0.01. Because at this stage of you building, at this stage of your formative years, you are not looking to trade for you to get profits. You're looking to trade for you to refine yourself, for you to get accustomed to, for you to first of all understand the market, for you to not find a strategy that is profitable, for you to not practice risk management, for you to not be able to control your emotions, before you not start looking for profits. And when we come into the investment world, risk manage risk management can be put to work in terms of diversification. Diversification meaning not putting all your money in one pair, in one stock or setup. That means if, for instance, you're an investor in your portfolio should not just be under bank sectors. For me, let me bring it to my home country, Nigeria. I want to also have banks in my country like First Bank, GT Banks, any bank. All your portfolio is under one sector. So that means if anything happens to the financial sector, of which you know that all these um, companies I just mentioned, they are all in the finance sector. So if anything should happen to the finance sector, your money is going to also be affected. As opposed to if you have the mindset of diversification in the sense that I have a share in a finance sector, I have a share in the health sector, I have a share in the energy sector, I have a share in the consumer sector, diversify when you're in the investment world, you want to diversify. Then emotional control, not letting greed or fear override your plan. People hear that, oh, Tesla is buying, Tesla is good. You go and you enter into Tesla, not knowing that Tesla is already on the all-time high. You're not supposed to enter there, you're not supposed to do that. Or emotional control, you see that a trade has left your area of interest and is already going. Instead of you waiting for the trades to come to your area of interest. You say, no, I cannot miss out, or I have to enter. Greed can also look like something whereby you've already gotten profits, but when you left, when you were taken out of profits and the trade was closed, the trade now started kept going forward, kept going up or kept coming down. And you just greed now comes in and says, oh, this trade is still buying, or this trade is still selling. Let me enter again. You now enter that money that you've already made just few seconds ago will be given back to the market. So you have to check in all these things. You have to know if you have greed, remove it because it's going to be a canker worm that will eat deep into not just your mental state, but into your capital as well. And that is the end of today's class. So enjoy the rest of your day. Thank you very much for paying rapid
Thank you.
attention. Cheers.
Okay.
Bye.
Bye-bye.